Welcome back, everybody, to Magnolia on Money, where we discuss everything financial from the economy to retirement. I'm Ed Cox with Magnolia Wealth. And today, as promised, we're going to bring you the state of the market. It's a little bit longer of a show, but there's a lot of material I wanted to cover. And so I'm not going to wait around. Let's just dive into the material. I hope this kind of helps you understand, where we've been, where we are, and maybe where we're going. Okay, so the agenda is basically three topics here, three areas. We're going to look at how's the market performed, what's driving the market performance, and then where are we headed. So let's look at how we've performed. So last year, we basically, in the S&P 500, round numbers, we were down 19.5%. Okay, last year, that was 2022 returns in the market. So 2022 was particularly interesting year when it comes to bonds and stocks. So since 1926, there's only been 3 years where both bonds and stocks turned negative during the same year. So in 2022, and 2022 was the most pronounced correlation, where bonds were down about 10% and stocks down about 20. And a lot of people thought bonds were your safe haven. But with interest rates rising as fast as they did last year, most bonds turn negative, as investors can find better deals, elsewhere. So one of the reasons, and I've talked to a lot of you that have come in, and last year we talked about it a good bit, our decision in the portfolios to go to get out of mid and long-term bonds and go to very short duration bonds, that happened in January of last year. And so we were able to basically curb most of this downturn loss in bonds. When the Fed started signaling that they were going to start raising rates, you pretty much know that what bonds are going to do during that period. So we got off the into very short duration bonds. Okay, so this shows if we're looking at the stock market and people are saying, Ed, should I get in? Should I not? Should I wait? Is it a good time? I really kind of look at the price to earnings ratio which is what this is showing us, the S&P 500 index price to earnings ratio, as are stocks expensive? Are they cheap? Or are they fairly priced? Kind of right there in the middle. So when we look at stocks, a price to earnings or a PE ratio below 15 is considered cheap, while stocks above 18 are thought of as expensive stocks. Currently, right now, we are at 16.65. So we're kind of right there in the middle, and you can see our 25-year average has been 16.82 times. So if you ask me today, are stocks expensive, cheap? They're fairly priced according to the forward price to earnings ratio of the S&P 500. So what is driving the market performance we've had? You're tired of hearing it. I know you are, but the Fed had a big part in last year's return, and they'll have a big part in what's going to happen this year. So this is showing the history of the Fed's rate hikes back to 2000, and you can kind of see where we are right now. You can see the dramatic increase that we had here. You can see back in 2004 when the Fed realized we've got kind of the market was red hot here. You remember what happened with prices of houses and everything else. It rose, and then we had our 2008 crisis, and they were back down to the bottom. Our problem's right here. The Fed kept the rates, in my opinion, too low for too long. And so now we're having to deal with that today. On a good note, I do think that we're almost to the top end of what the Fed plans on raising rates. All depends on inflation, what happens this year with the labor market and everything, but it looks like from their estimates and projections and then what the market expects to happen, almost topped out. Okay, so we'll probably see a couple more rate hikes, maybe 0.25% or so if this holds true. So, Ed, why do you believe the Fed was a little too late, to the game? Well, because inflation was at a 40-year high, last year. And most of the surge in prices we have seen has come from transitory, components related to supply demand imbalances. And this includes energy, new and used cars, food inflation. But when you look at the sticky inflation, it is also strengthened. And, even on its own, they separate this out between what we call sticky inflation and transitory inflation, and each of them make up a certain percentage of the total inflation. But, looking forward, we expect transitory inflation to eventually subside, and that's what the Fed's looking for. But the problem is when you deal with sticky inflation, and think of sticky inflation as maybe wages, it's hard to bring wages back down once they're back, once we've run them up. So there's things like that in the economy that are hard to bring back down once you've run those prices up. Those are considered sticky inflation. Transitory inflation are things that can change very quickly, like a car, energy, food. Those can fluctuate pretty quickly. But we are concerned about the sticky inflation. How long are those components going to stay around? And that's why they're looking at the labor force and what's going on with the labor numbers from the Fed. The other one that we dealt with is a stronger dollar. So in 2022, the dollar has been, was getting stronger to the detriment of other currencies such as as the euro. And in short, the U.S. dollar is driven largely by interest rate differentials, in the flight to safety from foreign investors. So with Europe suffering, inflation surges, a lot of foreign money has gone into the U.S. dollar. And the Fed is also appearing to fight inflation through higher interest rates, of course. We've seen that, which makes the U.S. dollar appear more attractive. All right. Higher rates, more attractive. A stronger U.S. dollar, tends to lead to a larger current account deficit as a percent of our GDP as well. So, in fact, it's more expensive for other countries to import from the U.S. because the goods are more expensive. A strong U.S. dollar is not kind of a good indication on the long term. So, however, as the Federal Reserve continues to fight inflation, more aggressively, as we've seen them do, other currencies will start to recover, slowing the U.S. dollar, with its increase. So we've had a strong dollar, which is hurting us in some of these situations. So the last component I'm going to say is affecting kind of current markets is consumer sentiment. So how does the consumer feel about the market? And if you can take one thing out, it's a very busy graph, but if you can take one thing out of it, the average subsequent 12-month returns of the S&P, when the sentiment was at the top, the average 12-month return after a peak of the sentiment was only 4%. When we were in the trough or the lowest points, the subsequent 12-month returns were almost 25%. You can see where we are here. Consumer sentiment hit a very, very low number right at 50, and we've started moving up from there. So typically, on average, there's the return after a trough of the next 12 months of the S&P 500. Good news, really good news. But it's just a marker. It's not like that's a guaranteed thing. Okay. So let's see where we're headed. What are the talking heads on Wall Street say? So the 2023 forecast, you can see JP Morgan's S&P 500 target. They see 4,200 on the S&P. Bank of America was 4,000. Morgan Stanley was 3,900. So, it's various across the board. You've got some bearish firms like Morgan Stanley, and you got some of the bullish firms like JP Morgan. So we'll see. But, as you've seen over the past and other presentations that I've done showing you what Wall Street analysts have said, they're usually not the best predictors of the market. So we'll take all this with a grain of salt, and that's where they think. So you can see at the end of the year, this is kind of where the S&P number was. And from JP Morgan says we're going to be at 4,200, and Morgan Stanley's down at 3,900. Average is around 4,000. They really don't see a whole lot of growth in the market for 2023. I'll put my 2 cents in there. I disagree. I think by the end of the year, we'll have a decent return in the S&P 500. First part of the year will probably be a little rocky, but I think we'll get a lot of this under control and probably end the year on a decent note with what's out there today. That can change very quickly. All right. Also, as we look through, our forecast, in our year of kind of got some challenges and change that we expect, we see various potential opportunities for investors. Interest rates will continue to rise in 2023, but to a less extent than last year. And in the long run, interest rates being where they are now is actually a very good thing for portfolios. As we've gone through since 2008, it's been very difficult for the fixed income or your CD rates have really not performed at all. So having higher interest rates on our bonds and our fixed income side of the portfolio will really help your overall returns in the long run. But raising them, getting back to normal is a little bit painful, but all that in the long run should help out. We see slowing labor employment, basically due to lower consumptions. And we've seen some of those layoffs already. And we may see a short U.S. and global recession, which is, 2 quarters or more of negative GDP. I think that's going to happen. It's already happened a little bit last year, but we do see that happening. But after the economy slows down, the market will anticipate a recovery, as the market's always forward-looking. And due to the recovery anticipation, the dollar will begin to fall, and the economy will kind of bottom out, and then we'll see this recovery. So we think that will happen. I think it'll happen by the end of the year. We'll start seeing a pretty good recovery. All right, so we're also dealing with some higher government spending, as everybody knows. What will the next few years look like in government spending? You can see the peak over here, 1945, towards the end of World War II, and now we're at a peak again. We got here not in a war, but through, a lot of people would say, reckless spending. So as a percentage of our GDP as a country, we're getting very close to having more debt than our GDP brings in. And this is a dangerous threshold that we want to, as we want to reimburse our debt, pay our debt with cash that we generate as a country. We don't want to reimburse our debt by getting more debt. That's kind of a bad situation. So one of the things that I really think is one of the biggest threats to our country is our government spending. This is another graph real quick. It just shows total government spending, where it's going, and then sources of financing that spending. So you can see, where that's happening. There's that borrowing right now, where the sources of financing this budget is coming from, 17% is coming from borrowed money. The Federal Reserve balance sheet, you can see how fast it grew during COVID. Then we had the money after. that was put into the market. The Fed is now actually starting to shrink its balance sheet. It's going to take a lot of time, a long time to get back to where we were, probably 10 years, I'd say. And that's all depending on the economy. It could go a little faster or a little slower. But the Fed's trying to bring their tools back into their tool chest, so they are ready for anything that may happen in the future with the economy, so they have something to battle that with. A little outlook on U.S., Europe, and China. The U.S. is still the shiniest car on the lot, so we offer a lot of favorable opportunity. Our strength in real income and household balance sheets. We have a favorable labor market dynamics, corporate resilience. Our health of our banking system's good. Europe, they got a recession underway, high unemployment, double-digit inflation. They got the war, energy cost. The ECB is lagging the Fed in tightening. Of course, they have a weaker outlook on earnings. And then they got an aging population, kind of a long-term structural challenge that they're going through. China's got major issues there as well. Of course, you've seen the increased state control, decrease in private sector independence, which kills your innovation, questionable corporate governance, lack of shareholder protection. We've seen that as well with stocks. Return on equity and levels of profitability are just trending down. And, of course, they have a really bumpy reopening, and their property sector is in a huge bubble. So China's got lots of problems, a lot of problems. Let's look at the good news. I love ending on good news. So first of all, if you're a client of ours, we always say long-term growth accounts that we have here are 10 plus years, and this graph shows why that is. Okay, so the graph here is time and diversification and the volatility of returns. So it shows the historical returns by holding periods. Okay, so the bars on the show the highest and lowest return that you could have gotten during each of the time periods. So 1 year, and this is from 1950 to 2022. So in a 1 year rolling period, there's the worst, there's the best of each of the stocks, bonds, and then a 50-50 portfolio. So you can see as we move right and our time horizon goes up, look what happens to the negative numbers. They go away. So the longer you give yourself in the market, in your specific, whether it's stocks, bonds, or a balanced portfolio, we say 10 years plus on long-term money, you've almost eliminated all negative returns. So this is another, we highlight the returns investors stand to enjoy as the market moves back to its all-time highs. So forward returns are looking far more attractive, than was the case at the start of the year. So that was last year. Even if all-time highs are not set in the short term, you're still looking good. So just say we get back, it takes us a year to get back to our all-time high in 2020, January of 2022. 1 year, we will have seen a return of around 26%. If it takes us about 2 years to get there, then you'll see the annualized return is here, and the cumulative return would be here, okay? So 13%, 13.6 over the next 2 years, and so forth and so on. So I don't think it will take us that long, but we've got some good returns coming back to us, hopefully in the near term. And this was an interesting graph that I found. It's kind of a little bit, I'm not shown this before, but it shows the probability of a positive return. So 1 day, 1 month, 3 months, a year, 3 years, 5 and 10 years. So even on a 5-year return, 5 years in the market, there's a 92+% chance that you're going to be positive on your returns. Even on a 1 year, you're 77%. So you're way more likely to have positive returns than negative, in the market. And the longer you leave it there, higher that probability gets. Some other good news this year. Now the market was down a little bit today, but when I took this picture, it was up a little over 4%. So the market already is up about 4% on the year. We're trending towards the end of this month, and so that's good news as we move forward into 2023. I hope this has helped y'all. I know it's a little bit longer than normal, but we've got a lot of good things to look forward to, and we really feel like after we get through this first couple of quarters of the year, we'll really kind of get some of this bad news behind us and start moving towards getting those good returns back, get us back to our all-time highs, and we're optimistic about the end of this year. So hope this helped. God bless. Take care. We'll see you next week. Bye-bye.